Right, if you're self-employed, this video is absolutely for you. We're going to be breaking down what it means to be self-employed when it comes to a mortgage. So many times over the past 12 months, we've taken phone calls with misconceptions about how to apply for a mortgage, and I want to set the record straight. Hi, I'm Sam Fox, a mortgage expert here in the UK. And like I've just said, today I'm going to be talking about self-employed mortgages. But on my channel, I go into everything in terms of lenders, affordability, interest rates, products, you name it. My channel is here to help you understand the world of mortgages. So do me a favor, like and subscribe. It works wonders for the channel. And we know that 91% of you don't actually follow us at the moment. So make a middle-aged man happy by subscribing. Let's get to it. Actually, I don't know why I've just said middle-aged. You can do me a favor, just scratch that and tell them that I'm 33 and then we can go back and do that again. Is that all right? So a self-employed mortgage isn't this special product we can go online and apply for. It's simply the application process to tell a lender you are self-employed and the underwriter is going to look at it differently. Now, if you're self-employed, you're classed as self-employed if you own 20 to 25% of a limited company or you work for yourself. So this is things like sole traders working for yourself, limited company directors, freelancers, contractors, partners of law firms maybe. But the main difference is how your income is proven, not necessarily mortgage type itself. So if you're going to apply for a 95% mortgage, it's not a 95% self-employed mortgage, it's just a 95% mortgage that you're applying for as a self-employed applicant on there. So the main thing is we need to show consistency. So if you're self-employed, lenders can't go off an employment contract, they can't look at pay slips, they can only go off your previous year's tax returns, calculations, limited company accounts. We don't have the technology or the underwriting at the moment to say, you're self-employed for 1 month and this is what you earn. So they need to see some sort of history. So most are going to ask for 2 years, maybe 3 years worth of accounts or tax returns. Now a lender is going to average these. So if, for example, 1 year you've had 10 grand, 1 year you've had 15 grand, they're going to average them between the two and say your income's 12.5 grand. If your income has dropped over the last 2 to 3 years, they'll work off the latest year if it's the lowest. And if, for example, you've had a 10 grand year and then a 50 grand year, the lender's going to go, whoa, what's happening here then? So we need to give an explanation as to why your income has jumped so high. Some lenders are fine with it and they can use that higher income. Some are just invariably going to be risk adverse and say, we're going to average to 2 years anyway. So the sort of things that you're going to need to look at for a self-employed mortgage, your SA 302 documents, which if you have an accountant, they can get them for you. But this is the tax year overview and the calculation. Now, when you see this document, this is going to make sure it shows kind of income, the tax paid, the tax due, when it was paid, if you've paid it, if it's been late, all those sorts of things. That's a HMRC produced document, and it's kind of like their rubber stamp to say it's provided from a government website, and that's the income they're going to use. You might need a certified, prepared set of accounts for your business if you're a limited company or in a partnership or even sole trader, just to show your income and expenditure. Little curveball, if you've got a self-employed business and you're a sole trader and you have a car, there may be opportunities where you can remove the car if it's a business expense from your personal affordability to maximize your income. But if you need more on that, you can drop me a message. Now for company directors, you might want to look at salary and dividends. Now a salary might be what the tax threshold is. It might be 12.5 grand. Whenever you watch this video, it may or may not have changed, so bear with me on that one. Plus your dividend, and obviously an accountant will tell you there's dividend allowances, it might be more tax efficient, but you might not need to take that income. So there are lenders that will work off salary and dividends, or salary and net profits, or there are a handful that will look at salary and gross profits. Now we caught up with a good friend and client of ours called Leah Turner. Now Leah is a self-employed business owner who previously received the wrong advice, and she was told salary and dividend, it's the only way you can do it. You can't afford your mortgage. I'm really sorry. It's a no. She came to us. I helped her with a mortgage. We did salary net profits, achieved a better mortgage than what she was actually applying for, and she's now got her dream home. Take a look for yourself. When you were purchasing your house, how did it come about and what was your original experience like?
It was my technically a first time buy. I had owned a flat in the past, but I was purchasing this on my own. And I'd only had a business for 18 months. So I was in a bit of a sticky situation because I didn't have 3 years of accounts. So the original house that I put in an offer on was a bit of a disaster because I worked with a mortgage company who said categorically, I cannot get a mortgage based on my earnings because I haven't had a business long enough. And the advice that this person gave me was horribly incorrect, and it contradicted the advice I'd had from somebody else, but they weren't able to take on brokering my mortgage. And I got upset, and I think I phoned you because I'd seen you on LinkedIn. We were connected on LinkedIn. I'd seen that you'd been recommended by people I knew. And I'm pretty sure I phoned you up and cried on the phone to you, like the first time we spoke, because I was in such a, like, buying a home can be really stressful. And you looked at the facts and very quickly you said, there's really no issue. You'll be able to get a mortgage. You might not be able to go through the high street bank situation, but there will be a way for you to get the mortgage based on what you're earning and based on the history of how your earnings have increased. There shouldn't be any reason, and you shouldn't have to do the dramatic route to it that this other person had suggested that would mean insane amounts of personal tax and all of the stuff that went with it. So it was very, very stressful for me until I came to you, which he's not paid me to say, but genuinely made all the difference and allowed me to eventually buy my dream home.
So a couple of key takeaways. Income can vary and lenders see that as a higher risk. If your income's dropped the last year or increased the last year and hasn't stayed the same, they're going to ask questions. So it's harder to prove that affordability without the payslip, which is why they ask for more paperwork. They're not being a pain in the ass for the sake of it. They're just making sure, as a responsible lender, that you can afford the payments now and in the future. Now, being self-employed, depending on how we need to assess your application, might mean fewer options for you. Now, if, for example, you've only had a 12-month trading history with limited company accounts, your barrel of lenders you're looking at is really, really low. If you've got 3 years and they're really sustainable, then you might have more. So a couple of tips to improve your chances. Use a qualified accountant. Now, this can be worth the weight in gold. If a lender asks for an accounting certificate, problem solved. It's a 2-page form. We can work with your accountant and they can certify all the income that you've had. I'd always say keep your accounts up to date. We've all heard it. The end of the tax year is the accountant emails you asking for all your receipts. You go in with a big file of facts or a folder full of stuff for them to sort. Use modern technology, pay the 30 quid, have your P&L and everything at your fingertips, just so you know exactly where you're up to, as well as planning for your mortgage. I'd avoided writing off too many expenses before applying. Again, we've heard it. I earn 10 grand a year, but actually you earn 50 grand and everything goes through expenses. If you're only earning 10 grand a year, lenders are only going to assess that because they're going to ask for the supporting information from the HMRC, which will show 10 grand, and we can only get 4.5 times that. So if you are making 50 grand a year and need a bigger mortgage, just put through what you're genuinely earning. It makes it so much easier. You could always build a larger deposit and maintain your credit score. Being self-employed, income might be a bit hit and miss, some good months, some low months, but make sure that your outgoings are manageable on the low months when you're making income and the high months to make sure that you're always keeping up to date with those payments. We need to make sure you've got a good credit history. And we also want to show steady or growing income trends as well. If you've made £50,000 profit this year and £10,000 profit the latest year, then the lenders are going to look at that and ask some questions around it. Is there a downward turn? Is there a reason why? So you need to make sure whatever questions are getting asked, we have the answers for and we can back it up with evidence. And lastly, use a broker that knows where they're looking. We've had so many people in the last 12 months who've been to a broker, they've messed up the application, the house is about to fall through, they've come to us and straight away we've been able to understand incomes and place it with the correct lenders. So make sure you work with a broker that's worked with self-employed before. And if they're saying to you, pull out a dividend, it's the only way, ask them about net profits because it'll save you a load of money. So to finish off this video on self-employed mortgages, I'm going to go through a couple of questions and give you my answers. So the first one is, how many years of accounts do I need? Well, typically, if you're self-employed in a limited company, there are lenders that look at the first 12 months trading history, so long as you've got a certified accountant that can verify the income for you. Most are going to go for 2 to 3 years. Can I get a mortgage with only 1 year of self-employment? Yeah, you can. You can have 1 year self-employment. There are a couple of high street lenders that consider that, as long as you've got a good deposit, good credit history, and you've got industry experience. Let's say you're a plumber that was employed, but you've gone on your own. That all adds to the application process. Do self-employed applicants pay higher interest rates? No, so mortgage rates are mortgage rates, whether you're employed or you're self-employed. As long as your income and affordability stacks up and you've got a good credit history, you should get the same mortgages as an employed person. But if you need to maximize affordability, or we need a lender that can look at your income in a different way, it might cost a little bit more. But in general rule of thumb, they're all the same mortgage we apply for. What documents do I need to prove my income? Well, as a rule of thumb, you want your 2-year tax calculations and overviews. Your accountant can help you with them. A latest set of finalised accounts. Now, this will show 2 years. So if you've been in business for 2 years, your latest set of finalised accounts will show you both years side by side, so the underwriter can see the progress of your business. I'd do 3 months personal bank statements, 3 months business. but a lender might ask for 6 months of each, so you just need to double check that you've got them on hand. Proof of deposit if you're buying a house, and your accountant might need to do an accountant certificate, but working with the broker, they'll tell you how to package this up. Can I get a joint mortgage if one of us is self-employed? Absolutely. That goes without saying. If you're one's self-employed, one's employed, you can both apply for a joint mortgage. It's the same underwriting processes. All a lender's going to do is assess applicant one, if it's them, as employed, and applicant two as self-employed. So the only thing we need to make sure is that the affordability is assessed correctly for both people, and it's with a lender that would take the income from the self-employed and employed. So if you need salary and net profits, you might not be with a high street lender, for example, or if you need salary and gross profits, you might not be with a high street lender. So we need to make sure that the affordability stacks up and we position it with the right lender. All right, and there you have it. That's my guide to self-employed mortgages. Now, if it's been useful for you, like I said at the start, please like and subscribe to our channel, and make sure if you have any questions at all, drop them in the comments below, or you can email me direct. It's sam@ukmc.co.uk. Thanks for your time. I'm probably going to waffle on like I usually do, so I'll leave it there and I'll see you soon.